Welcome to the fifth and final webinar in Steer's Net Zero series. Thank you very much for joining. By way of introduction, my name is Matt Bull. I lead Steer's infrastructure finance practice, and I'm the host of today's webinar. For those of you who've not been able to attend the previous sessions, we've had some fascinating perspectives over the past 5 days on some of the challenges and solutions for decarbonising our infrastructure and our cities. In this final webinar, we're going to focus on the really important question, of course, of how we're going to finance what is a once-in-a-generation investment in decarbonisation and transitioning our economies. So I think, as we all know, decarbonising our cities and infrastructure will be a hugely capital-intensive and expensive exercise. It's one where taxpayer, government funding, and therefore public financing will undoubtedly have a key role, as it always does for large transformative projects. But as we go on a journey to net zero over the next few decades, as is the case today, fiscal constraints will continue to be binding here in the UK and in most countries, particularly, of course, in emerging markets where so much needs to be done in this respect. So we cannot ignore the trillions of dollars of private capital that can and will be used to meet these huge upfront investment costs. So in short, we can't do this unless private capital is also leveraged. So in this sense, the financial system will be absolutely vital in both incentivizing impactful and sustainable investing, but on the flip side, of course, disincentivizing the harmful stuff. So this is where green finance comes in. It's not a new concept, particularly in the capital markets, where both bond investors and issuers have started to consider the environmental, social, and governance ESG factors into their financing activities for quite a few decades, actually, although the growth has been slow and gradual. But the ecosystem that supports green finance and will give it necessary scale is probably still in its infancy and is still emerging. But we know the climate emergency is so urgent. And so we're going to see the framework for green finance evolve significantly over the short term as investors and the wider population, and that's you and me, because it's our money that's under management of investors. So increasingly, we are going to demand that our money is going towards genuinely green, sustainable, and impactful businesses and projects. So in short, the green finance market is going to be in fast forward. So to help us guide us through that fast-paced evolution, we've got two excellent speakers today. Hayden Morgan was instrumental in the setup of the UK Green Infrastructure Bank. He recently founded Morgan Green Advisory, where, amongst many other things, he's played a leading and convening role in establishing the FAST Infra initiative and its sustainable infrastructure label, which he will tell us all about shortly. So thank you, Hayden, for joining us today. Penny Latorre is a widely recognized ESG advisor with Ensphere. She has extensive project level expertise and experience of appraising the ESG impact of infrastructure projects for a whole range of different advisors, debt and equity. So thank you, Penny. In terms of format, for today's webinar, Hayden will kick us off with a presentation on the recent market-led initiatives to formalize the green finance market. So really a top-down market perspective. This will then be followed up by Penny, who will talk more about the specific project level, asset level ESG considerations, which need to be robustly assessed on behalf of investors if they're to gain comfort. So really a more bottom-up perspective. And then after that, there will be an opportunity for Q&A. Please submit questions through the chat function, and I will try to get through as many as possible. If you can send them through, please provide your name and company organization name when you do so. And so without further ado, over to Hayden and then followed by Penny.
Thank you, Matt, and hi everyone. It's great to be with you today, and thanks for Steer also for the invitation to speak on this webinar on this really important topic. Just a quick clarification in Matt's introduction there. I think you said I was working for the Infrastructure Bank, whereas actually the UK Green Investment Bank, which was 2012, 2013 when it was first set up, and then I was with the Green Investment Bank, which later became the Green Investment Group, for about a good 8 years. Obviously, keen interest also on the UK Infrastructure Bank, but I think that's a slightly different institution.
Sorry,
but no, that's fine. That's fine. Just want to clarify that's not to mislead anyone. That's great. All right. So yeah, maybe just flip to the first slide in my pack there. So I just wanted to outline a couple of the market-led initiatives that I've been heavily involved with recently, which I think would be of great interest to folk on this call. And also it's really precedent. So it's a great opportunity to showcase these two initiatives, and there's opportunity to get involved in helping to shape the final stages of the ISO standard, for example, but also implementation of both the ISO standard and the fast infrastructure label. So I'm going to come on to both of these. Now, it's also interesting because the ISO standard is designed for organizational level, for financial institutions. So it's sort of top down. The infrastructure label is designed for the asset. So these initiatives give really good examples of interventions at the sort of highest level, organizational level, but also at the asset level. Now, I see this as really important because this provides this classic alignment of interest between institutional investors and organizational investment into sustainable assets. So it's got that nice consistency there, but completely different initiatives at different stages of development. But like I say, by all means, add comments and questions into the chat, and if you want to get involved in any of these initiatives, I'd very much welcome that, and we can pick up those discussions afterwards. So first off, we're going to talk to the Sustainable Finance Principles and Guidance International Standard, ISO. This, in my capacity in this role, is I'm global convener. So I work with, I've actually got a sort of ISO hat on, and I chair the working group for development of this standard. It's as I say, a global standard. There's 25 countries involved. Each country has up to 5 experts for participating in the working group, so it's potentially quite a big group. And it's reached a key stage now where it's going out for public consultation. So I'm going to just spend a few minutes talking through that. Just flip to the next slide if we could. Just wanted to set out, so this is the sort of financial ecosystem or sustainable finance ecosystem, all the different interested parties involved in that. I've tried to map it out. It's not perfect, but it goes some way to show the different interfaces and interaction between all the different interested sort of parties, institutions and stakeholders within finance, and with that overlay of sustainability. So if we are going to mobilize the $1 trillion per year that's required to meet, for example, some of these net zero commitments, all these moving parts, and is very dynamic, needs to be pretty much aligned. And getting that alignment of interest between all these different stakeholders is absolutely crucial. There's a huge capacity building and educational piece there, from technical experts, many of whom are on this call, talking to financial institutions, and the other way around, financial institutions talking to technical advisors. I often hear, for example, that when I'm up in COP, it's absolutely obvious what needs to be done. Why is it not being done? And it's because of this gap in knowledge and interface, and this gap in alignment of interest. I won't go through all the different areas there, but you can see some of the key interactions. The bit in the middle is where the money moves around, but enabled to do that, there's all the enabling functions, all the stakeholders that can influence that, the market infrastructure, which is the sort of the platforms of how money moves around, and crucially regulators now. Again, I won't go through all the emerging regulation, but that is going to be absolutely crucial in terms of holding investors to account. And then the supply and demand bit. And then, of course, the green products and services, or sustainable products and services, which are now coming out. So that's a nice little snapshot of how that interacts. And we basically need to sort of interact and interface with each one of these sectors and parties. All right, next slide, please. So the Sustainable Finance Standard is a set of principles and guidance. It's called a framework standard, so it's not a certification standard. You can't get a certificate, but there is an element of assurance. I'm just going to quickly go through the key sort of aims of the standard. It helps to facilitate organizations to transition their business models and activities towards a more sustainable, lower carbon future. It helps drive value, so moving out of potential markets where there's less value, and help drive value and new investment opportunities presented by the transition. It encourages this notion of sustainable and profitable. We're not going to mobilize the private sector finance that's required at scale without it being profitable. So we're very much focused on that profit element. Projects need to make money. We're not talking about concessional stuff. We're not talking about aid. It's actual projects making commercial returns. Also risk mitigation is absolutely crucial here. Understanding risk, managing your risk, and then for TCFD, for example, disclosing that risk. Key to this as well is engaging with shareholders, making sure all those interested parties have been heard, and that their key concerns and whatnot are integrated and their expectations into your organizational strategy. Next slide, please. It aims to bring about cohesion in the market. So there's all different government initiatives, different regulation, different industry initiatives out there. What this standard does is bring it all together with a framework. So it's not trying to compete with anything. It's not trying to compete with the taxonomy, with sustainable finance disclosure regs, with TCFD. It enables all this. So it's cohesion rather than competition. It consolidates good practice as well. So it provides that benchmark that can be globally recognized. It enables more transparency. So more disclosure, more robustness, more credibility on your sustainability claims, and it's relevant. Quite a novel aspect of this is on the what's called technical committee website. There will be a curated set of best practices and existing initiatives out there, support and resources available for users to refer to, rather than integrate it into the standard and it soon become outdated. This resource will be dynamic, it will be relevant, and hopefully really useful for users of the standard. Next slide, please. So here's an outline of the actual table of contents. It's quite small, but hopefully you can see the key element there is the sustainable finance principles. And you'll see there's 7 principles there. I won't go through them all, but you can see the diagram, which we'll actually come to a bit later, shows the interrelationship of that. You've got the principles, and then which is in section 4, and then section 5, you've actually got the implementation, how to implement each of those key principles into your organization. So if we flip to the next slide, hopefully it will show in a little bit more detail that figure. Now, this at core of this figure is operational activities, products and services, and there is on the right there sustainable outcomes. So that's what we're trying to achieve. How do we get that? Through the activities, products and services of a financial organization. There's also an element of continual improvement, and in this context, that is actually raising ambition and performance against sustainable outcomes. So you can see that it's all interrelated, and it's all sort of consolidated around that core theme. In the interest of time, I won't go through each of them, but if anyone's got any specific follow-ups, then by all means either put a question in the box, or we can chat afterwards. That's fine. All right, next steps. Next slide, please. There is an opportunity, as I say, to get involved. It's going out to ballot. What's called Draft International Standard is going out for ballot. The next global plenary is in Portugal. It's actually in May 2022. So there's a bit of a typo there. Hands up, that's my fault. But yeah, it's that's where we're going to vote, hopefully, on the publication of the standard. Then there's a 6-month period where it goes through translation and through the ISO sort of administration phase, when it hopefully will be published in the autumn in 2022. But still opportunity to get involved. through national membership bodies. In the UK, that's the British Standards Institute. Okay, next slide, please. There's also various sort of YouTube channels and LinkedIn and a whole bunch of other ways to get involved as well. So just wanted to flag that. All right, next slide, please. So the other aspect I wanted to touch on is this new FAST infrastructure label. FAST stands for the Finance to Accelerate the Sustainable Transition in Infrastructure. And it was conceived by HSBC, OECD, Green Investment Bank. You can see all the bunch of folk on the left there. All these other organisations are involved in developing this label. So it's got great support, and it's been going on for about a year. And I've been leading supporting the Global Infrastructure Facility, which is a G20 initiative, which Matt actually is familiar with as well, in terms of leading some of the working groups, developing the standard, and actually wrote the framework document, which is the main governance of how the label can be applied. So let's just skip to the next slide, and I introduce you to the actual label itself. So the label is part of the FAST Infrastructure Initiative, but it's one of the transformational interventions that the initiative has developed. It was launched at COP26 at the UK Pavilion by the Chief Executive of HSBC. So it's got really good endorsement there. Some of the benefits are to enable developers and operators demonstrate the positive sustainability performance of infrastructure. It allows investors to rapidly do their due diligence and see which infrastructure facilities will be contributing to sustainability goals. And it should, in theory, lower due diligence costs, because if it's got the label, it comes sort of gift wrapped with a tie, a little bow tie, a ribbon, saying, there you are, it's all sustainable, all the work's been done for you. It's got the label, it's got the stamp of approval. Next slide, please. So I mentioned it's got significant support, around or over 90 trillion assets under management of endorsement from various initiatives. I've pulled out 6 there, but all these initiatives are supporting the label. So individual members of these industry bodies will be integrating label requirements into their investment activities to some extent. Obviously, we're just at the start of that process. It will be more endemic as we go along. Next slide, please. So getting into the nuts and bolts of the framework itself, I should just say, as part of the framework development, we did a benchmarking exercise against current regulation, current principles, current industry practice to identify the gap in the market. So again, this is not competing with anything. This is a standalone sort of thing that sits alongside Equator Principles, sits alongside PRI, sits alongside Sustainable Finance Disclosure Regs and Taxonomy. The core part of it is this framework document. Again, I won't go through the full requirements, but a bit like Equator Principles, you need to work through and pretty much tick off the requirements. There's 5 core requirements here around you have to demonstrate that positive sustainability contribution. There's 14 criteria grouped around environmental, social, governance, as it says there, adaptation and resilience. You need to meet baseline requirements against each of those 14, and you need to demonstrate positive contribution against one or more of those 14 criteria. Again, the framework document is in the public domain. I think there's some links somewhere. I can share them with the organisers, and we can share them afterwards, so you can see that as well. So next slide, please. Just in the interest of time, this is a bit of a busy slide, but the top half is pretty much traditional project finance, and I've tried to categorize it. It's quite simplistic in terms of its from left to right, feasibility right through to sort of operational. There could be even a decommission one at the end there, which is not currently shown, but it shows again the interface between how projects are financed, the public sort of side of it in terms of how that's set up, and then through the development, operations and whatnot. The bits in red down the bottom are the key additional bits for the label, which is around demonstration of positive contribution, disclosure and data reporting of that performance. There's an element of self-declaration. You can get the label through self-declaration. But also there's an element of external review which is strongly encouraged, and that element is akin to the second party opinion for green bonds, for example. So that's a very quick, we're sort of out of time now, for my section at least, run through. But just to say, these are, like I say, 2 initiatives which I'm involved with, real practical implementation to meet sustainability goals. Gives me real optimism that the folk that I've been working with, both on the public side, on the private side, with governments, all coming together to deliver real key interventions to help mobilize this private sector investment, as Matt said at the start, absolutely crucial to meeting our goals. So with that, I'll pause. Happy to address any questions at the end, and hand over to Penny. Thank you.
Thank you, Hayden, and thank you, Matt, for having me here as well. So I'm going to pick up from where Hayden left it and explain a little bit more about the realities of today's green finance and what is expected today. Next slide, please. So I think there has been an explosion of green finance and what should qualify and should not qualify for green finance. And I think that in the last few months, maybe year, there was a realization that a lot of things were being pushed through green finance without really scrutinizing whether the underlying performance was really sustainable. And as Hayden was saying now about the fast infra, there are now calls for saying, you need to meet a minimum standards, otherwise it can't be sustainable. So there have been, so I'm going to go through some of the things that we're seeing in the market and some of the initiatives that are being out there to prevent this greenwashing, as it were. One is obviously the investor scrutiny, and I'm not going to go into this in much detail because Hayden has gone through it. But there is regulatory requirements now imposed on investors. So there is SFDR in the EU and SDR that was newly announced by Rishi Sunak to be introduced in the UK in the near future. So this really puts pressure on investors to demonstrate that their money is really going into green products if they advertise it as a sustainable product. There is also pressure on investors through the investor chain. So there is PRI, there is the institutional investors, multilateral, etc., who are lending money and are saying, you need to demonstrate to me that you are taking all the steps necessary to make sure that your investments, so that your assets are truly sustainable. So obviously that investor is going to pass on those pressures to the asset level. There is the new standards, as Hayden said just now. There is ISO, there is FAS, but there is others like GRESB that have been around for a while that are also used to drive this credibility. But I think in this context, and since I started working in ESG, what I've seen overall is an increased sophistication by investors. So I remember in the initial days, you were just okay if you had an ESG policy, and you had an ESG policy that was the green card to play. Whereas now you need to demonstrate that that is fully integrated into your system, into how you perform your business, etc. And then obviously there is now this element of, okay, yeah, you've told me that this is green, but as Hayden was saying, there is an increasing demand for things to be externally or independently reviewed through second party opinions, for example, for green bonds. Next slide, please. There are taxonomies that are being used, and that's a sort of is a set of technical criteria that determines whether your asset qualifies or doesn't qualify for this green finance. The taxonomies so far have focused primarily on on climate change. The ones on climate change are very detailed. However, environmental are also coming through, and there are now consultations for social taxonomies to be developed. So the market is broadening, and there's been a realization that there needs to be broadened beyond the clean tech, etc. The regulatory disclosures are also gaining momentum. So it's not just the investors who are asking for information. There is regulation that is asking assets and operators and corporates to disclose their sustainability performance. There is the non-financial reporting directive that has been around for a few years now. It didn't really quite get the results that they were expecting. So there is now the Corporate Sustainability Reporting Directive being consulted on, that is going to bring a little bit more structure, a little bit more encouragement, and it will extend beyond the really big companies into a bit more of the lower tier below that. There are also standards out there for corporates like EcoVadis or the carbon neutral certification, etc. That there are badges that they can obtain, companies can obtain to demonstrate their credentials. And there are now watchdogs that are being proposed. So in COP26, there was an announcement that there's going to be a new UN watchdog that is going to name and shame the companies that are not fulfilling their climate pledges. Next slide, please. So in that context, in that universe where we are getting pressures from every direction to say, look, you really need to be truly sustainable. I tried through this slide to talk you through what truly sustainable might look like. As I said, having an ESG policy doesn't really cut it anymore. There needs to be a system, there needs to be a strategy, there needs to be a policy that is really embedded into a business strategy. So it doesn't coexist in parallel, it's just really part of the business, day-to-day business operations of an asset of a business, and is fully supported through a system of strong governance, which is really supported from the top to the bottom. So and there's a process, as Hayden was saying as well, there is a process of education of from board directors to asset managers on the ground to see why they should be doing this. So that's why I put there an element of ESG training, and that needs to be for all, not just having an ESG person in that sometimes get heard and sometimes doesn't. But the way to really embed this comes through understanding really where you're at as an asset, as a business. You need to see how your asset is performing now and where are your gaps and where do you want to be. And once you understand that, then you're in a position to say, right, and if this is where I want to be and this is where I am, I'm going to set a plan and targets to get there. So hence the road to net zero plans, etc., that are coming out. But also we must not forget that ESG is not only about the E, and I will come back to that in a minute. Once you have your plans and your targets, you will never be able to calculate or to understand your sustainable outcomes if you don't monitor this. And this is where we find that it can be a little bit difficult to get your hands on all the data. There are many ways to monitor, from using basic Excel to using sophisticated tools, online platforms that are available on the market, etc., that allows you to gather the relevant data. But one of the things that we are finding is that when it comes to doing the baseline, so coming back to the top, a lot of assets and a lot of business discover that they have data gaps, and that's normal, but it's about how to close them and how to achieve true monitoring and how to have results that are truly reflective of the performance of that asset of business in a way that is doable. It doesn't cost you don't need to employ 3 people just to do this monitoring. So how can I integrate that monitoring? If I'm collecting other data for financial purposes, can I tag that along with that, for example? So how can you integrate that monitoring? And there is then the reporting and the review. The reporting that Hayden has made reference, and then a review process where he said, is what I've done okay? Yes or no? Okay, if not, then let's come to the drawing board and review. Next slide, please. And this final slide that I wanted to put in front of you, I know that the font is really small, but in a way, this was deliberate because I think when we talk about ESG, a lot of people tend to, when we talk to them, tend to say, yeah, ESG is about the E. And it's not really about, it's not only about the E is important. It's not really about climate change only, although climate change is a very important bit of it. But ESG is about environment, it's about social, and it's about governance. So it's about transparency, is how do we do this in a way that is fair, and in a way that it gives the confidence that we're doing it the right way. And the reason why I put those lists over there is because sometimes we don't realize a lot of things. I've had discussions with clients where I've discussed HR or anti-bribery and corruption, and suddenly there's been a drop of realization, like, oh, I didn't realize that was part of the ESG piece. So cybersecurity, yes, that's part of the ESG. So ESG is so broad that we just need to broaden that understanding of it to make sure that you are dealing with each of the parts of the ESG. I'm conscious of time, so I think I'm going to leave it there, and Matt, if that's okay, and then maybe leave it to the audience too.
That's brilliant. Thank you, Penny, and thank you, Hayden. A really comprehensive overview in such a short time of the evolution of the framework, of the standards, and also the day-to-day practical considerations that have to happen at a project or business level. So that was really excellent. We've got a few questions that have come through. Please send any more. Your chance to interact with 2 experts in the field. I'll just start with one that came through from our home base, so from Juliana Quintero in the Infra Finance team, which is really around KPI monitoring, I think, which you've just raised, Penny. This question speaks to enforcement. So in a green bond or green loan structure, what are the effects of breaching them? How are they different from traditional financial covenants? Because it's good to have the KPIs and to monitor them and see if they're going well, but what's the effect? Is this evolving at all? I don't know. Hayden, do you want to go first, and then maybe Penny?
Yeah, thanks, Matt. I guess the short answer is it depends on the structuring of the instrument itself, the bond or the loan, and the specific covenants in there, because a breach of covenants is actually quite a significant default basically in instruments. However, some of the more modern instruments that are coming to market around sustainability linked loans are whereby your interest rate that you repay back on the debt goes up or down depending on your sustainable performance. It's really challenging to get the KPIs that are accurate and robust and credible. But where they can be done, and everyone is happy with that, you can link it to the base rate that gets paid back. So if your performance goes up, for example, you pay less interest effectively. That's sort of the way it works. Typically, these are done at corporate level, so they're not really a project level bond. So they're sort of corporate. But I think that innovation in that space, we're going to see a lot of this going forward. And anything that sort of, I guess, enhances or incentivizes more sustainable performance should be welcome, even if it's not 100% sort of perfect. So it's one of those classic, you know, don't let perfection be the enemy of good in this sort of market. But yeah, getting those KPIs, making sure they're absolutely transparent, absolutely robust, following best practice, that's really important. Penny, I don't know if you've got any thoughts on that.
I think in my experience, you know, I'll link it back to your comment, Madam Juliana, about green bonds. Generally, what you tend to do is you set out your KPIs, you measure them, and you have a set of criteria that makes the project eligible for that. But normally in the green bond or the green loan framework, there is normally a section where it says, okay, if your asset stops performing and it doesn't meet that, I am allowed to take my funds from that asset and take it to another one that is performing, so that it's meeting those KPIs, and that is allowed within the framework. Normally, there's normally that flexibility within it. I think the issue might become where you don't have any assets that are eligible anymore, and then obviously that will present a problem with the governance, as Hayden was saying. But there is normally that level of flexibility to take them from here and to something else.
And just to follow up on that, because that's very much a question at the structure level, at the loan level or the bond level. Just on your, Hayden, some of your initiatives like the label, for example, is it envisaged that you can you gain the label, you can lose it? Is that also the case?
Absolutely. So again, it's sort of self-regulating. So there isn't a regulator that will strip away the label, but it's more the court of market practice, effectively. But the label is one of the key pillars of the label is transparency. So stakeholders can, in theory, when it's set up, really challenge the performance or disclosure of the actual asset itself. The reason that's important, I should have said actually, that there's going to be a data repository which will sit alongside a new secretariat. We're currently going through a process to set those up. We're going through some funding at the moment, and hopefully within a year or so, the secretariat will be functioning alongside that data repository. The data repository will show the performance of every single asset that has the label. And the performance. So this whole sort of KPI metrics transparency is core to that, and that's self-policing, because without that transparency, you could open it up to greenwashing. So we wanted to avoid that. Now the label, it could be that the once constructed, for example, the asset is not performing as was planned. Then it may not be appropriate to have the label associated with that asset. So, you know, there will be challenges in, and I'm sure there will be some misrepresentation in the market, but it's really for investors to call that out and stakeholders to call that out, you know, depending on a project by project basis.
Yep. Okay, perfect. Thanks, Hayden. Thanks, Penny. So we had a question from John Carr at Association of Transport Coordinating Officers, ACCO. So really a comment for the debate. I think in our previous sessions, we've taken the whole range really of decarbonisation projects and initiatives, from the relatively small to the really big and capital intensive, and it's really at that latter end where there's, you know, huge R&D that needs to be done in both developed and developing countries. What role is green finance going to play in that space, and the interaction between public and private, you know, maybe de-risking, for example, just because of the sheer scale, but yet the sheer potential impact. So particularly thinking of aviation is I guess is an example. So how is the private and public sector going to work together on this from a green finance perspective?
I can maybe have a go at that. Having some experience at the Green Investment Bank, we often got asked this question, and we got sort of involved in well, now it's called Jet Zero, which is part of the UK government green 10-point green plan. and I guess that innovation piece there, it's really up to government to make sure the enabling environment and the incentives are right for that early stage sort of venture capital, or even before that angel sort of investment. Now, you know, I think there's going to be huge innovation and R&D in this area. Obviously, there's going to be some winners and losers, and also, you know, around hydrogen. That's another sort of classic one as well. And how can that be, you know, integrated into the mix? But I think we're going to see a lot more diversity, especially around, you know, energy, especially around fuel, and mobility and whatnot. And so that, like I say, that government incentive is going to be crucial to enable investors to invest with some less risk, should we say, and to, you know, get those returns. But if I would just say, apart from the sort of really early stage stuff, any project which is obviously potentially profitable is going to attract private investment, and that is for government to work out how best and which schemes to support and which technologies to support on that one.
I think in my experience, green finance is at the moment very attractive to the private sector. There is a lot of appetite in this respect from institutional investors to private equity, etc. So there's a big appetite. So I think the projects that perhaps, and the companies or the assets that really have legs, we will get the funding. In fact, I was talking to some institutional investors a couple of months ago, and they were saying that they want to invest more in this field, but they were struggling to find, you know, viable projects in this respect, but they're willing and they have the cash ready to deploy. So what we've seen is when there is a project, a business startup, you know, where is an existing asset looking to transition, there is huge competition to invest. So we are seeing that. I guess it's trying to navigate the, you know, the world of what we think is going to work and what is not, and that sort of technological, when sometimes financial individuals are not necessarily well versed on technical, and that's where it is important to have good technical advisors behind you to say, you know, right, you know, yeah, we think this is going to work.
Yeah.
Just
so,
Matt, sorry, just follow up on that. To make the observation, there's no lack of capital here. There's no lack of finance for good, profitable projects. It often see that, you know, especially in this sort of COP discussion, where's all the finance? You know, that for good projects, honestly, that are financially viable, you know, you will attract capital. And capital, as Penny said, is absolutely sort of tripping over itself to invest in these sort of projects. So
yeah,
there's this sort of myth that there's a lack of capital. That's not the case at all.
Yeah, it certainly is the case. There's just what's often referred to as the wall of capital, I think, and I think it relates to a couple of questions that have come in. There's, as you say, well-structured, commercially viable projects, money will flow to them if they've got green credentials, and that's proven. They'll probably be oversubscribed, right? But at the flip side, is it the case that brown projects or loans or bonds, etc., they're becoming undersubscribed? So a few of the questions relate to, are we starting to see that change in demand and preferences starting to affect the price of capital between brown and green projects?
I can maybe, I mean, there was some work done recently by Goldman Sachs around the cost of capital for various assets, and the cost of capital for new oil and gas is now 20% higher than it used to be, and there's a much lower cost of capital on obviously green projects, and that's in sort of traditional project finance. So the cost of capital, definitely. That being said, there's always going to be a home for brown assets, and this whole divestment sort of question is really interesting. Do you divest on brown assets or try to encourage them to transition to lower carbon, more sustainable business model. And we've seen some interesting, sort of hedge funds that have got involved with Exxon, for example, in the US, to actually get board seats to force them to transition. So it's, and you see about Royal Dutch Shell locating in part to London and abandoning the Netherlands because of this, so they say, net zero transition. So it is having some effect on these sort of brown industries, if you want to call it that, because of this whole transition requirement.
Yeah, and sorry, Penny.
I think, Matt, what is important for this sector is to have the transparency and the strong ESG to demonstrate that transition. And I think that if it is a business or an asset that can demonstrate that it's transitioning and so on, I still think that they will attract the finance. They just need to demonstrate transparently that they are on that journey, and that is not just the greenwashing.
And that comes down to the rigor that you were talking about, Penny, right?
Exactly.
And
exactly.
the value of the frameworks that Hayden has outlined. I think that the Goldman Sachs, which I think probably quite a few people have seen that analysis, is really quite startling. I'd love to get underneath it a bit more actually to see because you are talking about a 1,000 basis point swing between renewables and oil and gas, and it's quite fascinating. And as we say, the market is moving so quickly. Just finally, because we're running out of time, but a few of the questions that have come in all relate to this one final issue. I'd just quite like to address is concerns that the ESG whole ESG focus at the project level kind of becomes like a cost center, a cost item and tick box exercise. So making sure that it's that it's a really value driven exercise rather than that, and also just the other thing is the actual transaction costs. What would be quite an enormous monitoring and evaluation challenge, particularly in emerging markets, where I think, Penny, you pointed to data availability being a challenge. So I suppose these different questions relate to the trade-off between rigor and the practicalities and cost of trying to get data together and do sound analysis. And that's quite a challenge, isn't it, I guess? And that's one we've got to get better at optimizing. Sense. Penny, you're probably best to start with.
Yeah, I think that in my history, ESG used to be the tick box. It was first the E, then it was the ES, and finally it was the ESG. So that kind of like the evolution over time. And it was a tick box exercise. So we have worked on transactions and on assets where we came in, we did an assessment, we came in 5 years later, and we literally changed the date in the report and handed it back to them because nothing had happened, nothing had occurred. I think that the value now, and I understand what you are saying, Matt, that about the cost of transacting and so on. I hope that they now realize the potential for value creation that ESG brings, and also value preservation as well, and hopefully that is what is driving the need to get underneath these issues in at this stage. And therefore, whilst yes, so you might think, okay, so I'm spending a little bit more than I used to now at this stage, that will really show later on by having more sustainable assets and businesses that can longer term be more profitable and therefore have better returns.
Yeah. On the commercial, long-term commercially viable projects and successful projects, the ones that have these principles, I guess. I mean, that's the way to, that's the advocacy, I guess, we all need to do about the value up front of this work. I don't, Hayden, you've got any thoughts on that?
I would just echo those comments from Penny. We've definitely seen a price differential between sustainable assets compared to non-sustainable assets, and those that can demonstrate performance in terms of sustainability performance, you know, there is a cost associated with that, but I mean, there's a cost associated with project development anyway, and it's small in comparison to the overall cost of, you know, construction and getting the project through planning and whatnot. So I would argue that it's not an administrative burden. It should actually be that value enhancement piece that Penny mentioned, and that transparency and robustness in data underpins the confidence in the market on all this stuff. And I think you know, certainly some of the more sophisticated investors are seeing that now. But again, I go back to that education. It's our job as advisors and engineers and you know, to engage with project sponsors, engage with parties and investors to explain the benefits, explain the value add, and also, you know, explain the risk and what happens if you don't do this sort of stuff. And specifically around, I'm thinking climate risk, infrastructure, you know, 50-year potential lifetime. What's the world going to look like in 50 years? That's again something to be thinking about.
Yeah, absolutely. It's that counterfactual. I think with something we work on at a project level every day, and yeah, it's really important. So I'm just mindful of the time. I think that's we're at 10:50, so we're running a little bit over. I think we've run through most of the questions. I don't know if Hayden or Penny, you've got any final remarks on this?
Just very briefly, given we're sort of out of time, I think it's such an important consideration. This, as I keep saying, this interface, the alignment of interest. The more that we can talk to investors about this, and we've got some real key practical initiatives coming through now to support all the different parties to meet sustainable goals, whether that's organisational level or asset level or throughout the whole sort of process. I think, you know, that I'm really optimistic that we can sort of help solve some of these big challenges. Thanks.
Thank you. Penny, thanks.
I think I echo that. I think that it's just, and that point about education and understanding, I think I tried to do that from my presentation, but I think it's very important that and finance now gets full alignment, and we're seeing that happening, but it will be interesting to see where it goes next.
Absolutely, it's a fast-moving space. Absolutely, Penny. Absolutely. And yeah, and thanks so much to both of you for your expert input today. It's really fascinating, and encourage everyone really to engage, as I think Hayden has outlined. These initiatives are sort of they're open and collaborative, and you can input into it, and we all kind of have a role in this professional space to input into it. So do that. That concludes this week of sessions on decarbonisation. They will be available probably sometime next week or maybe the week after, all online, if you want to catch up with any of the other ones, and we'll be doing a few other bits and pieces around follow-up on those sessions. But at this point, that closes the webinar. And again, thank you so much for attending, and particular thanks to Hayden and Penny for their brilliant presentations and the discussion that followed. Okay, brilliant. Thank you.